Hey guys, it's Sebastian from AskSebby, and today we are going to look at some pretty big potential changes to your credit score with FICO 10. Before we dive into it though, a big favor is to give it a thumbs up. It really helps with the algorithm, and it's also free. And this relates to the device that we're talking about today, which also really helps with the FICO algorithm with your credit score, and is also free advice. FICO 10 is supposed to be out this summer, so 2020, but we're likely not going to see it implemented at banks until another year or so 2021. So to put it into perspective, a lot of banks right now still use FICO 8, which was developed in 2009, so more than 10 years ago. The reason it's going to take them time to implement FICO 10 is because their credit scoring algorithms, their models that they rely on pretty heavily, and how they make their decisions on who to lend money to, who to approve to, and credit limits, interest rates, and all of that are reliant on FICO 8. So moving it over to this new system is going to take time. With that said, there are going to be two major ways that the FICO 10 score is going to be different, and you need to be aware of these things in order to make sure that what you're doing still works based off that new algorithm, based off that new system. The easiest way to think about the first change is that your credit score now has a memory. So instead of it just being a snapshot right now, it's going to be a look back 24 months, so up to 2 years. So instead of just one snapshot, it's 24 different snapshots. The reason this is important is because there are going to be a bunch of people who end up having a lot of debt and then they clear it off for 1 month to increase their score in order to apply for the card again or to apply for new cards, and that ends up being a credit risk. So with this memory, they're able to look back multiple months and look back 24 months, and they want to see that on average, normally you're not increasing your debt, you don't have higher revolving loans, and they want to make sure that it's either going down or ideally it's staying low. There is going to be a very easy way to game this, especially for someone using your credit cards responsibly, but we'll talk about that in a second. Number two, and it does relate to the first one, is that personal loans are going to be punished a lot more now. Easiest way to think of it is that you have installment loans as well as revolving loans. Installment loans are going to be things like your mortgage payments as well as your student loans and car payments, while revolving loans are going to be credit cards as well as personal loans. My guess for why they decided to incorporate personal loans a lot more in FICO 10 is because they saw people taking out these loans and they realized that their current model, FICO 9, wasn't really that representative. So you had these people who had a lot of credit card debt, they would refinance it using these personal loans, and then they would accrue more credit card debt and then eventually probably bust outs. With all of that said, what are the ways that you can optimize this in your favor to make sure that your credit score is actually either better than your current risk or at least equal to your current risk level? The best way to think of it is that it's a game and you really want to just hit the criteria for the game to do well, like hitting that thumbs up button for YouTube. So with the first one, with that look back, with that memory, the easiest way to play it safe, especially for people who are normally part of my audience, who watch a lot of my videos and who do a lot of the right credit things anyways, is going to be prepaying your cards. This is something I've talked about in a lot of my other videos. Some people really don't like the practice because they feel it's not worth the effort, but with this new FICO 10 model, I think it actually is very important. So the easiest way to think of this is, let's say you have a credit card that has the statement end date on the 27th of January. This means that it started on the 28th of December and then it goes until January 27, and then once it closes, they tell you that you have to pay a certain amount within 2 weeks of that date. But what you can do is actually prepay that card beforehand. That way, when that statement closes, it looks like a smaller number. So for example, if you have a $10,000 credit limit and you end up using $2,000 of it because it was the holidays, you were buying gifts, you were taking trips or something, and you can actually prepay that down to, let's say, $1,999. You do a payment of that amount. That way you have 1 out of 10,000 instead of 2,000 out of 10,000. You're looking at a 20% utilization versus effectively a 1% utilization. Some people definitely feel it's not worth the effort, and I don't think you need to do this every single week or every time you make a transaction, but before that statement date ends, you know when that ends because you have this information, you can just do that prepayments. For most of your credit cards, you can do this pretty readily. American Express, you can't do it in your first month, but afterwards, second, third, fourth month, you can do multiple payments, and even if you can't do that, on the credit card side, you can actually prepay using your bank account, so you do a push payment instead of doing a pull payment. So when you go into your checking account, you always have that pay bill option. It does typically take 2 days, but that still works out in your favor. Just make sure you time everything correctly. I'll do one more example because I think people might be confused. Let's say you have a credit card where the statement closes on February 14th. You're using your card like normal because most people need to use their card, but you don't want it to post a high utilization. So on maybe the 10th or maybe the 9th, you end up paying most of that off. It doesn't have to be the whole amount, but the idea is that you drop it to a lower rate, especially if you did use it a lot. Maybe you ended up buying a pretty expensive Valentine's Day gift. You can think of a credit score as someone going into your credit card and taking a picture of that statement to see how much you owe. Like with most things, you want to make sure you look good, and there's a few ways to play it, because if you're someone who's responsible, if you're not using too much of your credit anyways, then you probably already look good. If you're someone who's ugly, then you can clean up yourself before that picture to look better than normal. Taking this strategy and with this 2-year look back, it means that your credit score is going to look pretty good. The obvious question is, well, I can't do that. I can't pay off my cards in full. Then I would strongly recommend considering whether credit cards are for you. I think if you're someone who's not able to pay off your credit card balances in full, then I wouldn't really use credit cards because you're not getting enough rewards back. So it's not really worth that spend. Same thing with buffets and pretty much everything else in life. I'm not going to go unless I get value from it, unless I'm hungry. With the second one, personal loans, I think this one is a bit harder, but I would recommend also not taking these unless you really need to. If your roof caves in and you need to take that loan because you need to repair that roof so you actually have a roof over your head, do what you need to do, but pay that off as soon as possible. If you're someone with a lot of credit card debt and you're consolidating, so let's say you have these 19-25% credit card interest rates that you have a huge balance on, yes, consolidate it into this personal loan at 5 or 6, 7%, but work to pay down that amount, just because even with a lot of other investment opportunities, there's not really a risk-free way where you're getting that 5% or that interest rate they're charging you back. One final use case that's really going to suck for certain people is the ones who are doing arbitrage opportunities with balance transfer offers. So I do know a bunch of really smart people who end up taking these 0% balance transfer offers and then putting that money into a risk-free investment such as a CD account and then taking that difference. It's an arbitrage. It only really works when there's no transaction fee or when the transaction fee is substantially lower than that CD amount, and it makes sense because you're getting 1 or 2% for doing nothing by taking a small hit on your credit score for the short duration, but in the future when you need to fix it, you can pay everything off. With FICO 10 though, this actually pokes a gigantic hole in this strategy because they have that look back period. So it's going to look like you're very risky, and that doesn't really work in your favor. Maybe if you're someone who doesn't need to get a mortgage anytime soon, but my concern would be that it would tank your score and it would make doing this long-term very difficult, if not impossible. Normally, these people would end up doing balance transfers. You carry it for 12 to 15 months, putting it into that CD or into a very high yield saving account that earns you something like 3 to 5%. And then afterwards, you take it out, pay back that loan, and then you do another balance transfer in a few months. With that memory, it's going to look really shady because you have 15 months or 12 months or however many months of that very high balance on that card. For most people watching this, I don't think you need to be too concerned because you're probably doing the right things. Even if you decide not to do that prepayment, your utilization is likely not going to be high enough that it's going to cause you problems. Maybe if you're someone who is using business spend and you're using your personal cards for that business spend, then that might be problematic given the snapshot thing that I talked about. But most people, you're going to be good. As a reminder, the 2 biggest parts of your credit score are going to be payment history. So that is going to be on-time payments at 35%. And then 30% is going to be your utilization. Utilization we already talked about, and as long as you don't miss any payments, you're pretty good for the most parts. Credit mix is something that I don't really talk about, which represents 10% of your score. A lot of people ask me why I don't recommend taking on a mortgage or getting a car or something, or a personal loan just to increase your score. And the main reason is because I think that's pretty stupid. I wouldn't take on a mortgage that I wouldn't want just to increase my credit score. Same thing with a car. If you need a car and you're going to get that anyways, and that's fine, but getting a car for the sake of increasing your credit score seems like you're doing the wrong things. Your credit score at the end of the day is going to be a tool to either get you a mortgage, ideally at a lower interest rate, or to get you a bunch of rewards and to take trips that you otherwise would not be able to take. Or maybe it's to get extra cash back, but the idea is you want to make your credit score work for you versus you working for your credit score. Yes, I'll happily prepay my cards. It doesn't take that much time. You can do this while watching Netflix. I think if you're someone who does other things like researching topics for videos, or researching what to buy while watching Netflix, you can easily click a few buttons to prepay your cards. On that note, if you are someone looking to get extra cash back, or maybe you're looking to take another trip and you want to learn about any credit cards, a very easy way to support our channel would be using the links that are on our website, AskSebby.com, as well as down below in the description box. Hopefully that was helpful, and my question for you guys is, what are your thoughts on FICO 10? Do you think it's fair? Do you think it's not fair? I know some people have been telling me that it feels like the rich are getting richer, and I kind of agree, but you do need to play the game, and this seems like the best way to play it. And I think it's not necessarily fair, but it feels fine. It seems like it makes sense. That's just my thoughts though. I would love to get your opinion. If you liked the video, give it a thumbs up. If you know anyone else who'd benefit from this, and I'm pretty sure a bunch of people would, share this with them. It'll probably help them out. But otherwise, hope you guys liked it. See you guys next time.